we go to 35 asset managers and we'll pick up their forecasts for all of stocks, all bonds, and all commodities. And then what we do is we average that out. So we then get the average of what I call the wisdom of the crowds. So we then have, here's what the future returns could be, right? It's not a guarantee, but it's, gives you a sense of, helps you look through that front windscreen as opposed to just looking through the rearview mirror.
Some advisors have a completely different perspective than other experiences. It's just the whole.
I think you hit on such a good point because
for today's episode, we have the founder of the Index Standard, Laurence Black. How are we doing today?
Well, great to be with you today.
So you guys have done these ratings of gold, platinum, copper for those indexes. And what is the goal of providing that knowledge for an advisor when they see that type of rating?
One is we really want to provide a clear understanding of how that index works. And then secondly, as you referenced, if you see an index that's just got too much of a straight line, I would stay away from it because, why is that not index designer running a new big multi-strat hedge fund, right? You got to ask yourself that question. So I like to see something with a bit of variability. I like to see an index that's got some academic backing, or it uses established underlying indices or ETFs. You can go look at the performance because...
So what have kind of been your biggest takeaways from viewing these volatility indexes here since going live back in 19?
I would say a couple things. One is...
systems work, people fail. Welcome to InsureMark's Advisor Mentorship Podcast with Vice President Jeremy Hauser.
Welcome back to this week's episode of the Advisor Mentorship Podcast. I am your host, Jeremy Hauser, and boy, we are coming up on the close of 2025. Can't believe it. Here we are in just a couple of years, back-to-back to almost back-to-back years. We'll see how it ends, but looks like we've had some positive markets here over the last almost 3 years, and couldn't have a better guest on for today's episode. We have the founder of the Index Standard, Laurence Black. How are we doing today?
Well, great to be with you today.
Good. I'm looking forward to our conversation because I know your team a little bit about what you guys are doing, especially for the industry when it comes to fixed index annuities. So maybe a lot of people, we've had a lot of new viewership here over the last couple of months, some RIAs and groups that aren't familiar with the fixed index annuity space. So for those that don't know about the Index Standard, what is that? And also, can you tell us a little bit about your background, Laurence?
Sure. So I'll start with my background first. I've spent most of my career in investment banking for my sins. Started off as a risk manager and then became a bond trader. And then I spent the vast majority of my career developing and designing indices, which is something I always love. You're always kind of learning about new markets and creating new things. So it's a fantastic place to be. And I ended the last 10 years of my career where I ran the Barclays Index Group. And then I actually left Barclays in about 2019, and I began working with Robert Schiller, who I developed some indices with at Barclays. And, at that point, I thought I was just going to be creating indices. But what I found was I got a lot of questions from people. People would say to me, what is this risk control feature? Or how does an index credit or in a crediting strategy? Or why are these indices so complex? So I got a lot of questions, and then that got me thinking that potentially there was a gap for someone to come in and help evaluate and help people decode and demystify all these indices that we see in the insurance and structured product space. So on the back of that, I founded the Index Standard. Today, we've got 8 people and a wider range of clients, from a lot of large insurance clients, insurance distribution, and increasingly broker dealers as well. And we also got a focus on structured products. So today, just to put it very simply, you can think about us as a mini Morningstar. We rate and evaluate indices, and we have tools to help people understand these products. And again, you could find that all on our website.
Love that. And actually, you referenced Schiller, who's actually been a guest on the show. For back in 2019. So 2020, what I love about your team is you guys put out some incredible work for the white papers on a quarterly basis. I think going back to 2020, you started doing that with Schiller. So how have those done? And I mean, what led to doing those quarterly white papers?
Well, Professor Schiller is probably best known for something called the CAPE ratio. He's a well-known behavioral finance economist. And what we wanted to do with those papers, and by the way, that's separate from the Index Standard, we sort of want to take a step back and look at where are markets now and what is sort of potentially might the long-term returns be. Everyone has a real short-term focus these days, and we wanted to sort of stay for the long-term investor, where are we in the cycle? And Professor Schiller developed the CAPE ratio, and the way he likes to use it actually is to use that CAPE ratio and think about forward returns. So that's essentially what we do in this paper that Professor Schiller and myself write. We think about what might the future returns be, and we use the CAPE ratio as really our key signpost around that.
So, I mean, fast forward, unbelievable, right? So you started this, it's been 6 years, if you can believe it, since you launched
Yeah.
the index standard. So we look back now on all these volatility controlled indexes. So there's over 200, probably approaching 300 that are in the fixed index annuity space. So what have kind of been your biggest takeaways from just educating yourself, but also viewing these volatility indexes here since going live back in 19?
I would say a couple things. One is the innovation is constant. I mean, I sort of thought maybe you would be a sort of slowdown, but every year there's something new and innovative. So I would say the innovation is really constant. There's always something new to look at, which actually makes it a very interesting space for us. And I think there have been a couple innovations that have been really very strong, and one sticks out for me. I think there we've seen a new technique called the intraday volatility control. And that's an amazing technique. It really delivers sort of better performance in your standard risk control, because it's almost like looking at the data more frequently. And it's like having better shock absorbers.
Mm.
And, it provides better returns for the end client, and it actually prices better. So you get more participation. So I think that's been an amazing innovation. And then, on the sort of flip side, what I would say is we've probably seen too much complexity sometimes in some of these indices. And, we haven't always seen that complexity has worked well. So I think, the industry is learning, and I think we've seen a real focus on these intraday technique and combining it with well-known standard benchmarks. And that provides a lot of value for end clients.
So how do y'all determine, like, I know for those that aren't familiar with your expertise and what all your team does when it comes to doing some great, like, just the complexity of these indexes, it is in depth, and your team takes a deep dive into understanding, what asset classes make this rebalancing. I mean, really just going into the weeds to educate the advisor of what these are. So you guys have done these ratings of gold, platinum, copper. So how do y'all determine what those are for those indexes? And is that, like, what is the goal of providing that knowledge for an advisor when they see that type of rating?
There's a lot in that question. So I'd say, we review each of these indices, and for some of them, I think we once saw a document 360 pages long. So it can get very involved, and a couple of the team have got masters in finance or PhDs, and they're index experts, and they'll dig in and really understand what's going on. And our objective is a couple fold. One is we really want to provide a clear understanding of how that index works. So we'll draft some very clear and straightforward language. And then secondly, as you referenced, we give an index a rating, much like some of the major rating agencies like CFRA, like FactSet or Morningstar. Our particular system, we go from platinum, gold, silver, and copper. And those are kind of what we call our metal categories we think are solid. And then we have neutral and watch. And what we'll do is we'll look at 35 metrics, and we're trying to evaluate each index and compare it to a similar peer group. And by the way, we'll never compare, let's say, a dividend index to a risk control index. We'll only compare a multi-asset index that's risk control to another multi-asset risk control index. And the objective is really to try and identify indices that are robust and well designed. And I would say, we're always trying to sort of tweak our rating systems with this in mind. And one thing we've learned over the last couple of years, we've really been looking at a lot of these indices and how they perform. And we found a couple of factors that we think have become very important and help explain some of that performance. And actually, as of this month, we're about to introduce that new factor into our rating system. So we think it's going to make our ratings system even better and has more relevance to the user.
Selling the Ibexus FIA Plus and Wealth Defender FIAs just got even easier. They have increased street comp by 1% for clients aged 71 and up, putting more in your pocket while helping retirees grow and protect their wealth. Plus, Ibexus has raised participation rates so you can offer even more value and upside potential. It's a win-win for your clients and your business. For more information, go to www.insuremarkamp.com/jhauser and click on Learn More. Don't miss this opportunity to boost your earnings and deliver stronger solutions. And are they, so for instance, if let's say we have the best of the best in your rating system as it sits today as platinum. So what does that tell an advisor of it's just more stable? So regardless of what ups and downs in the market, or does that mean better returns or?
So firstly, what it tells you relative to its peers, and that's a key point, right? It's all relative to that group. We have
Mhm.
a couple of groups of risk control indices. So we'll have a multi-asset group. We'll have a group that consists of equities and bonds, and then another group that has maybe just equity only, and then structured payoff. So those are the kind of way we think about these types of risk control indices. And within that group, our ratings a platinum will indicate that that index is robust and well designed. It's not necessarily linked to performance as much, but this new factor we're adding will kind of tie in with that. And if you're interested in performance, we actually produce 10-year forecasts where we take the wisdom of Wall Street and we apply that piece of wisdom. Let's say Wall Street might have S&P, they'll have an S&P forecast. We'll take that forecast from the S&P and we'll look at each index, how much proportion of that index is related to the S&P, and then we'll attribute it to the S&P. We'll do the same for commodities and bonds. We can build up a picture, and then we use that forecast to try and help people think about the future, because looking at the past is not necessarily the best guide. It's almost like when I drive a car, right? I don't drive my car just looking through the front windshield all the time. I look through the front windshield, I look forward, I'll occasionally glance at the back mirror, right? So I think when you're dealing in finance, you want to be doing the same thing, right? With your most important finance decision, you don't want to be looking at historical numbers, right? It's like driving your car, looking at your rearview mirror, which you can't do. So you want to think about the future as well. And that's what we provide. We help people think about the future.
And so, I mean, the elephant in the room for a lot of these volatility controlled indexes across the board, not all. I mean, there's actually been some that have done incredible.
Yeah.
But I mean, you look at the S&P 500 the last 3 years, and coming off 2022's down year, it seems like it's roared back and some. But some of these vol indexes, particularly the 5% volatility controlled indexes, have just been relatively just flat or maybe a little bit up. Some have actually been negative. So, like, why is that?
So a couple things. The first thing I would say is you can't really compare these indices to the S&P, because the S&P is like a Mustang, and let's say the vol control indices are like a mini SUV. So if you want to compare them, you either have to look at something called the risk adjusted returns or your net credits. That's where you really want to think about them.
Mhm.
And you think about a car magazine, right? They never compare that Mustang to a mini SUV. They'll compare the Mustang to a Porsche 911. So that's kind of level one. Now, if you want to compare them over the last couple of years, I was just checking before this, the last 3 years, your average risk control index has been around about at 4%. You think about your par rate on that's probably between 2 and 300. Let's just say it's 2.5. So you want to multiply your 4 by your 2.5. So you're kind of going to get to around about 10%. Now, the S&P has done incredibly well. So let me make a couple of observations about the S&P, then come back to the risk control indices. So number one, we have been treated to double-digit returns on the S&P over the last couple of years. And that is incredibly unusual, right? If you go back and look at long-term equity market type returns for more than over 100 years, you'll see the S&P averages between sort of 6 and 7-ish. So the fact that we've had in the last 10 years probably annualized at around about 11% is amazing. So let's all be happy about that. But then thinking going forward, that's something you've got to think about. So S&Ps had been on a tear. Now, what's happened with these risk control indices? I would make sort of two observations. One is a lot of these indices on the market are what's called excess return. So what is excess return? Well, excess return is what an index will drain a borrowing fee. Now, it's almost like buying a stock on margin. If you want to buy a stock on margin, we all know you got to pay some interest. So an excess return index is a little bit like buying something on margin, and it extracts a borrowing fee. So now what's happened is these excess return indices were designed for a low rate environment. They came out, let's say 2011, and they've been prevalent ever since then. And the time to use them is in when a really low rate environment. Let's say like we had from 2010 to almost 2019-ish.
Mm-hmm.
So that's the environment they were designed for because, let's say from 2010 to 2019, what was the average interest rate? Probably, let's say, just like 1%. So these indices were extracting 1%. It didn't make a huge difference. Now, in the last couple of years, we've recovered from the great financial crisis. What has the interest rate been? Well, in actual fact, these excess return indices, they've drained 5% over the last year. So they should really be used in a low rate environment, or so that has made some of their performance challenging, right? But on the flip side is you've got higher par rates. So if they did manage to eke out some kind of a return, that return was magnified by this high par rate. And then one other last thing I would kind of say, financial markets are so difficult to build an index. Every year something new happens. So the volatility control mechanism is really, it requires almost like an early warning system. So what I mean by that, you mean the index needs a gradual rise in volatility to be able to say, okay, something bad might be happening. I'm going to take my money from the risky asset and put it into cash. And let me give you an example. Let's think about 2007, 2008. We all know the kind of trough in 2008 was Lehman. But what happened before that? There were a lot of signals that volatility was rising, and it told these vol control indices to kind of get out of the risky asset. So 2007, you had New Century Financial. So a mortgage company get into trouble. They actually went bankrupt. So volatility starts to rise. The vol control indices put money into cash. Then you had B&P had some hedge funds got into trouble. Then you had Bear Stearns. So at this time, volatility is going up. The indices are saying put more money into cash. And then by the time you have the big one, Lehman, they're like, okay, we knew something was happening. Most of our money is in cash, and they buffer on the downside. They perform really well. Now, what happened this year, unfortunately, Jeremy, was we had a policy announcement on a Wednesday afternoon from the administration. It's kind of very little warning of volatility, and the markets whipsawed then. And that really hurt these volatility control indices in April. But, they've kind of come back, and I was just looking at the average returns year to date of all the vol control indices, and it's about sort of around about 3%, just shy of that. So it's been okay, but it hasn't been where the S&P has been.
Help your clients renovate, reinforce, and take pride in their financial home. North American has some exciting news. They've just launched a powerful new resource designed to help make client conversations easier, more engaging, and more impactful. Discover the blueprint for organizing, protecting, and upgrading your financial life so you can build a lasting legacy and approach retirement with confidence. It's called the North American Financial Home Makeover Campaign. It includes a magazine, a microsite, and an online client prospect assessment. Pretty cool. These resources will help you spot retirement gaps and opportunities, build more long-lasting trust, and start retirement conversations that really matter with prospects and clients. To access this amazing resource, reach out to our team or go to www.insuremarkamp.com/J Hauser and click on Learn More. Which is accurate. And I can actually attest to, because I have a lot of advisors that chat with me about upcoming renewals. So renewal rates of different carriers, where the participation rates are. and also like what the performance has been. And I was just talking to a guy literally yesterday,
Yeah.
and it came back where the S&P 500 for this product, it was a 2-year point to point. It was 50% participation of the S&P 500. The client made like 22% in that allocation itself. But in the same essence, the vol controlled index with that particular product, it was the Schiller Global, and the client actually made 21% in that same 2-year period because of the high participation rates, right? I mean, you're not going to knock it out of the park every single time, but it is one of those where many of the other indexes that maybe were allocated, they were flat. So it just starts to become like some advisors have a completely different perspective
Yeah.
than other experiences, and it's just the whole picking the winner, right?
I agree. And, I think you hit on such a good point because what we see is there's such a huge allocation to the S&P, right? So let me make some observations because from a portfolio effect, it's been wonderful. S&P's done well. Some of the risk control indices have been so-so, some have been good. But from a portfolio effect, you've actually done well.
Hmm.
And I would say I think diversification is the most important thing. So what I would say is if a client loves a benchmark, whether it's the Russell, NASDAQ, or S&P, allocate to that, but really blend in some of these risk control indices to be diverse. Because, I've been talking about diversification, and I remember maybe 2 or 3 years ago saying, put some money into EFA and into emerging markets. And some people said to me at that time, well, EFA's uninvestable and emerging markets, I would never invest in China. And I'm like, well, you just want to be diversified. But then look at year to date, right? Both EFA and emerging markets have had fantastic years. They've outperformed the S&P. So you just don't know what's going to happen. And I think, Jeremy, people have recency bias, right? We've been treated to such spectacular returns from US tech and US large cap that you just want to be a little bit diversified because you just don't know what's going to happen, right?
Couldn't agree more. And also like the industry doesn't know, because I mean there was literally a one of them, I'll pick on it. It's and it's an index that as we're recording today and when this goes live, so this index will no longer be available for new monies. So anybody who buys a policy with this company, this index is no longer available for allocation at all. So that's the Citi Grandmaster Index. So this one, you look at it, couple years back, this won a couple industry awards, and it was basically best volatility controlled index, or I forgot what they titled it. It was like best new index
Yeah.
according to this particular group, and now it's gone in 2 years. So like, how do they miss that, or what happened, or what do you think in your observation as you analyze all these indexes?
So I would say I don't want to sort of comment on that particular one, but I love all these tough questions because we've got to answer them. So that index, as far as I know, it's a multi-asset index. So let me kind of explain what's happened to multi-asset indices.
Okay.
So as a generalization, a lot of the designers, when they're looking at this, they rely on a concept of diversification. And what does that mean? That means they say we're going to blend in some stocks and bonds and maybe some commodities and maybe some gold, and we're going to hope that they're going to move up and down at different directions. So that's the key concept when they were building these indices. And then, as I said a little earlier, right, financial markets will always come up with something new. And in 2022 and 2023, we had a very unusual phenomena where equities went down and bonds went down. Now, that hasn't had in 75 years, they haven't gone down in the same calendar year, but they did in 2022. And a lot of multi asset indices had equities and bonds, and they were built on the expectation that they would yin and yang, but they just didn't in 22 and 23. So that hurt a lot of the performance of these multi asset indices.
Hmm.
I'll make another sort of observation is we at the Index Standard are sort of taking a longer look at some of these indices. And as I said, we've come up with some new factors to really identify if we think these indices are over engineered. And sometimes we see amazing straight line back tests. It'll be 45 degrees. And, I take a step back and I say to myself, if I look at that index, that means that you could predict the great financial crisis. You could predict COVID and you could predict Liberation Day. And I'm like, well, I don't know, right? So my sort of advice is if you see an index that's just got too much of a straight line, I would stay away from it because, why is that not index designer running a new, big multi-strat hedge fund, right? You got to ask yourself that question. So I like to see something with a bit of variability. I like to see an index that's got some academic backing, or it uses established underlying indices or ETFs. You can go look at the performance because, just when you see the straight line, you got to ask yourself some questions as well.
That's a good point, and the fascinating thing too. So, I mean, obviously, that one index. There's another one that same particular product itself, and as it's going away for people to purchase on forward going basis, those indexes are actually up this year. So the irony is like, oh, out of some of the ones that are not necessarily performing, those are performing, but now they're removing it.
Yeah,
So that's where it just it just gets into just confusion.
it's hard. And that's also my point around diversification, right? You just want to blend in. If the client loves an index, let them choose it, but just blend in something else there because you just never know what's going to happen.
So, do you think advisors should feel confident? So, now analyzing these things for 6 years, should they feel confident with volatility controlled indexes, or should they just be leaning all at S&P and the well known ones?
What I would say is a couple things. So first of all, I was speaking to a chief product actuary, and he was saying to me, "Listen, these volatility control indices are not going anywhere because their pricing is so stable that they can deliver consistent par rates, consistent renewal rates." And I suspect sometimes they also help subsidize the S&P because the S&P, it can go parabolic and the pricing can get really expensive.
Yes.
So, these indices are here to stay. And I almost think it's sort of, I know there's that old expression, it's darkest before the storm or whatever. And we've had an amazing run with the major US indices. And everyone is like, oh my gosh, they've been amazing. I'm just going to allocate to them. And now these risk control indices are delivered, I don't know, 3% year to date. I mean, it's called add on the par rate, maybe it's 6. And people, oh, I'm not going to allocate to them. But I think now's the time you want to be thinking about that because you just don't know what's going to happen, right? We've seen actually the S&P tumble in the last week, and Europe and emerging markets are okay, right? So you really want exposures to other asset classes. So I think you really want to be diversified more than ever right now because people are falling in love with tech or these single names that are AI boom. They're falling in love with those names, and we just don't know what's going to happen, right?
Are you tired of seeing your clients' renewal rates going down? Maybe your customer started out with a 5% cap, and over the years, it has been cut down to 2%. Sound familiar? Lock in guaranteed rates on Prosperity Life Group's newest FIA, Path Pro Series, an A-excellent company now with a 16% premium bonus with no fee. PLG's Path Pro Series has you covered. You can find Prosperity's perfect renewal rate scorecard and more at www.prosperitylifearc.com. That's prosperitylifearc.com. In reality, so y'all's white papers that y'all are doing, that those are when y'all do y'all's forecasting of like Japan, then you got S&P 500, I think it's Europe as well.
That's correct.
So pretty consistent on those three of, the who's who. But when y'all do that, y'all look over the next forecasting of 10 years, right? Or is it, what's the time frame?
We actually do 10 years, both with Professor Schiller and then at the index standard as well. Because, what I would say is anyone who can trying to predict 1 week, 1 month, 1 year out, that's incredibly difficult. You don't have much chance. But looking over 10 year, you can sort of look over a cycle, be a little bit more thoughtful. And that's what we do at the index standard. So, and I don't generate these returns by myself. What we actually do is we go to 35 asset managers and we'll pick up their forecasts for all of stocks, all bonds, and all commodities. And then what we do is we average that out. So we then get the average of what I call the wisdom of the crowds. So we then have, here's what the future returns could be, right? It's not a guarantee, but it's, gives you a sense of, helps you look through that front windscreen as opposed to just looking through the rearview mirror. So that's the key thing. And then, if I look at these expected returns,
Hmm.
in the US, they're forecast to come down, right? So on the US large cap equity, S&P 500, we're expecting returns of in the 6% range, 6.5 range, right? So that doesn't sound like much, but that's kind of back to historical averages. Number one. And why is that number coming down? Well, because in the last 10 years, we have been treated to spectacular returns and valuations are incredibly high. So I work with Robert Schiller, and he has something called the Cape ratio. And the beginning of November, the Cape ratio actually hit 40. And just to give you a sort of context, in about 144 years that he's been calculating the Cape ratio, it was only expensive more than 1.7 years. Out of 144 years, the S&P's only been more highly valued 1.7 years. So, again, you just want to take that stuff with a pinch of salt and just make sure that you are diversified. So that's the US. But then conversely, if we look at valuations in Europe and Japan, they're a little lower. And if I look at the wisdom of a crowd, these 35 asset managers that we go and poll, they expect higher returns in Europe and Japan, and actually emerging markets as well. So I think it makes sense to really just be a bit diversified, because that's where returns may come from, because valuations are low.
I mean, we're essentially on the first white paper that went live. We're basically at we're at halftime, so we're 5 years in to the 10 years.
Yeah.
And I think a lot of what you're saying, it resonates too. But it's so hard I could just like put myself in the advisor's shoes of just like, oh man, like seeing the S&P returns and not wanting to chase it. Just like, I mean, that's what makes these guys, it's just so tough for the conversation with customers of like, so the next 5 years. So would you say if you go back to 2020 and you put yourself in today's shoes, would you change anything about the S&P 500, or do you think that 10 years of what you're forecasting is probably going to play out?
What I would say is, at that point, if I recall, our forecasts for the S&P were probably on an aggregated return basis. We're probably in like 4.5s. But what I would say is we had higher expected returns for Europe and Japan.
Yeah, I remember
And
that.
it's hard to figure it out, right? I think we'll probably do okay, because um, Europe and Japan look like they're performing well, and the US has exceeded our expectations. But we've been driven by an amazing new technology that I think is going to be amazing. But it certainly looks like valuations have got ahead of ourselves. So as it stands, we've under forecast on the S&P, but things are beginning to change. The narrative around AI is changing. So one just never knows. Um, and what you can sometimes do is look, instead of looking at the raw returns, and like right now, as we're forecasting S&P at the index standard about 6.5. Europe, we're sort of forecasting about 7, 8, and then emerging markets maybe 8 or 9. You can use that as a guide to say, okay, I want some allocations to everything, but because I know it's going to be potentially a little higher in Europe and emerging markets, so maybe I'm just going to make sure I've got some exposures there. That's the way I would think about
Yeah. No, good points. And actually, one of the main so thanks for talking a lot about this, because I mean it's a hard topic
it.
for a lot of advisors. So I know you and your team have done some incredible work. It's a long play as well too. And one of the other things I saw, I think it was a couple weeks back, you guys announced there's I think a strategic partnership, or somehow y'all are now affiliated with BlackRock. You did like it was called like Beyond Benchmarks, right? So what is that?
So we wrote a research paper with BlackRock, and again, it's really helped. Well, the objective is to demystify some of these complex
Hmm.
concepts we see in indices. So in this paper, we kind of explain a couple things. One, how does this risk control feature work? Two, really what makes a good index? What should you look for? And then we get into a couple complex topics, which are very topical. And the key one is excess return.
Hmm.
We have a great, in this paper with BlackRock, there's a little special section on excess return, and there's even a pullout. And that is so topical because we are getting so many questions around excess return indices. It's almost a couple every week. So it's great to have this BlackRock research that we can share. And one of the key things we like to do at the Index Standard, it's really about education. My goal is to make sure people understand what they're buying and to really help them do better. I want them to retire with more money in their pocket. So we feel this is a really important paper to help people understand these new indices.
Unlock new accumulation opportunities with EclipseMark fixed index annuities issued by Standard Insurance Company and available exclusively through Legacy Marketing Group. Offer up to 15% annual penalty-free withdrawals after year 1, plus many rates that are guaranteed not to drop for up to 10 years, a key advantage in today's uncertain rate environment. And for you, earn competitive upfront or trailing commissions. Learn more. Visit www.legacynet.com. EclipseMark is a product of Standard Insurance Company of Portland, Oregon. Licensed in all states except New York. Features and availability may vary by state. This message is for licensed insurance producers only, not for consumers. Legacy Marketing Group is an independent agency not affiliated with Standard Insurance Company.
I take myself back to, it was probably about 4 years ago. I don't know the exact date, but I remember when they came out, BlackRock, with their specific, there was a white paper, or it was like a 9 to 11 page document talking about how an FIA, it was amazing to me because it was just random, an FIA as a better bond alternative. And they put that out there on the street. But it seems like over the years, they are definitely wanting to educate people that are using their services more on these. And to your point of the excess returns, like we see it. I mean, I've especially maybe not as much today, but who knows what the future holds. But I remember 4 or 5 years ago, getting into an insurance company and the S&P 500 for your customer, you start off at like a 50% par rate, but yet that par rate drops down to like 25%. And then to your point of the excess returns, those aren't moving. So I think that's what you're talking about, right? When it comes to more stability.
Yeah, you'll see very stable par rates on vol control and excess return, because essentially what they've done is they control the volatility, and that's the key thing in what drives the par rate. And then they remove some of this interest rate risk. That also keeps it very stable. So they're easier to manage from a product shelf point of view from a carrier. They can understand what the pricing will be really through the life of that contract. So it enables the carrier to deliver really stable pricing.
And where can they go for people that do want that BlackRock piece? I mean, I know I have it and I can send it out to whoever requests it for me. But like if somebody's just listening, do y'all have it on your website, or where do they get that?
Sure. You can actually email us at info@the-index standard, or there's a couple people at BlackRock, Sarah Garrity, and her team can really help people with that as well. So that's the best place.
Awesome. Is there anything else your team is, anything new?
A lot. Yeah. So we're super busy. So a couple things. In the sort of short term, what we've been doing is we currently provide model allocations for fixed index annuities. And we're now actually covering about half the RUL market. And our goal in the next couple of months is actually to finish off the RUL market and actually add RILAs as well. So that for us is going to be a major effort, and we're delighted to have covered a lot of the index-linked insurance products. So that's the one thing that we're doing.
Mm-hmm.
And then secondly, the other major driver is we see a lot of demand, and this is probably more from advisors, to really understand an FIA or a RILA sort of from a due diligence perspective. Like, I want to understand what's the credit rating, what's the renewal rate situation with that carrier. Then they want to understand what's the service like, how many NIGOs do they have, right? Then they want to look at some product attributes. What kind of indices do you have? Are they well rated? Are they diverse? What's the expected returns? So what we've come up with at the Index Standard is what we call a due diligence report, and where we examine each FIA and we kind of rate them on all these attributes. We have two sort of key categories. One is where we look at all the carrier attributes like rating, service, NIGOs, and renewal rates. And then the other key category is where we look at product attributes, where we examine expected returns, diversification, and indices. And we've been had that in the works. We've shown it to a lot of clients, and we get such a great reaction. And that's going to be a key launch for us in 2026.
That's great because that's something too, right? It's the some of the carriers. That's incredible. So like you're able to generate that data, even though some carriers don't have necessarily
Yep.
renewal rate integrity pieces.
So some of it is survey driven on the service and the NIGOs, and then on the renewal rates. We're just right now looking whether you make those available, and increasingly more and more carriers are opening up to us and coming to us and disclosing those as well. So as we get more mature, we're getting better quality information, and our objective is to really help the industry grow by providing transparency and showing that where these products are good, and also where they can be useful, but also showing attributes around these products so that the advisor or the agent can feel very comfortable when they're positioning them with end clients.
Do you ever see yourself going into like platinum, gold, silver, and put like the insurance carrier and rating them?
So what we do is for each of these two sort of attributes, one where we have the product attributes and then the carrier attributes, we kind of have like a spider graph, and then we show
Okay.
the industry average. So you can very clearly see where each of these carriers, if they're strong. Some of them might be very strong, let's say, in credit ratings and service. Another one might be very strong in the returns that they're delivering. And each agent or advisor might care about different things. So whatever they care about, they can zoom in on the factors they care about and really see if that carrier is above average or not.
That's really cool. And when does that go live?
It's still to be seen. We've got one client is working with us on a customized version, and then we've got that in the works to be launching in sometime in 2026.
Very cool. And so for those that are maybe newer to the index standard, so where can they get information for you guys? I know we talked about the BlackRock piece, but where's a place that they can, do y'all have podcasts, or where can they get educated more? Obviously, our team here, for those that may not know, so our advisors within our portal, they have access to index standard through us. But for those that are new, where do they go?
You can follow us on LinkedIn. We post a lot on LinkedIn that kind of updates on all the new content that we're producing, or new partnerships, or new products. And also go to theindexstandard.com. And for any queries, info@theindexstandard.com. You can email us, and we'll get back to you.
Love that. So as we're wrapping up here, any words of wisdom or final thoughts here for the audience?
My sort of final thought is I see markets are really, I think have become a little bit sort of gamified, where we see these 2-3 times leveraged ETFs on single stocks. And now there's a new provider who's even launching 5 times leveraged single stocks. And I think it's an environment where people fall in love with some single stocks, or some technology indices, or benchmarks. And I think in this environment, you really want to be diversified. And I've seen someone in my family put too much money into a single stock and it didn't go well. So I'm not just saying that, like, I've felt what happens when you put too much money into a single stock. I really think in this environment, you really want to be diverse, because with all this FOMO and YOLO, there's a lot of love. People are just falling in love with some single stocks and technology stuff. And you just really want to be diversified at a time like this.
FOMO and YOLO. I love that. Actually, I should ask you this, because I mean, you got a really good relationships and thumb on the pulse. So I know of there's a carrier that's coming out with some sort of a Bitcoin that's going to be offered through fixed index annuity, a particular carrier. Do you see, is that a trend? Is that going to kick off to the point of what you just said with leverage and so forth?
I definitely think it's a trend. I think carriers are responding to demand. I remember I gave a speech, maybe it was 2 years ago, for a carrier, and there was an audience of 300. And I was talking about indices, risk control indices, the S&P, the NASDAQ. And then I got questions. Every single question was on crypto. So, people just love it. And I think, listen, it's very volatile. it makes sense to put it in a protected asset like an FIA or a buffered asset like a RILA. So I can definitely see it coming. It's going to come.
Yeah, because I do know one that's already doing it, that I was just curious if you're hearing that from others. So,
It's hard to know. What my gut feeling is the following. We saw a filing even a year ago for it, but it never happened. And I think that my sort of sense is that once one particular issuer launches with that, the market will follow, but no one kind of wants to be the first. But once you get one, your floodgates will open.
that is wise. Yes. And that's how the insurance companies work.
There we
So,
go.
no, appreciate your time, Laurence. And thank you also to the listener. Hope you got a lot out of today's conversation. Make sure to subscribe to the Advisor Mentorship Podcast so you do not miss out on any future episodes. Follow us on YouTube. Subscribe to our channel at Jeremy Hauser AMP, and also check us out at LinkedIn at Jeremy Hauser. And remember, as you share this episode with a friend or a colleague, remember, in a world full of betas, be an alpha.